And then you know the drill in terms of taking the exam. Any questions about anything before we get into the problems? And I'm around the next couple of weeks, so if folks have questions, feel free to reach out by email. We can discuss over the phone or set up a Zoom. Okay, so turning now to this exam. So let me point out just a few things. So there will be, the instructions will probably look pretty similar. Again, you'll see those. So I don't think there's really anything noteworthy here. Again, there'll be instructions about how to upload, download, upload, that sort of thing. And then there will be an assumptions page like there is here, where it'll say, except unless otherwise indicated, specifically here are the background assumptions, and much of them are consistent with what we've done in class. So just keep apprised of those. And obviously elections can make a big deal. But again, even though there's no election made under the background here, in a particular problem, it might say an S election is made. So these are the sort of default assumptions. And then we go into the problems, and we've got problem one. It's just a pretty garden variety, 351 problem. People contributing stuff into a new corporation. A, B, and C are the transferors, and they're receiving all of the outstanding stock of NewCo, which has common stock and preferred stock, non-voting preferred stock, but A, B, and C are all property transferors, and so they have 100% control of the company. So this is a good 351 transaction. And once we conclude that, then we can go shareholder by shareholder. A is pretty easy. A is contributing cash. There's no gain in cash or loss in cash. So A has no gain or loss. A takes a $50,000 basis in the stock that he receives. And of course, the corporation has, $50,000 basis in the cash. So A is not all that interesting at all. B, on the other hand, is interesting. B is contributing two properties. Each has a built-in loss. And so, again, if you're issue spotting here, when you have a built-in loss contribution, property with a built-in loss, we have to at least consider 362E2, which is going to affect the corporation's basis. But in terms of B, B has an amount realized of $25,000 of the NewCo stock, $20,000 worth of the preferred stock, and $5,000 cash. So that totals $50,000 of amount realized. And there's the $70,000 of aggregate basis. So, and we know that there's no loss recognized. So this loss is realized, but no loss recognized for B. The interesting question for B then is, what is his basis in the stock that he receives? So let me pull up the whiteboard here. Under 358, it will tell us what the basis, aggregate basis of the stock received is. One second. So the aggregate basis of the stock received, again, the problem here is that B is receiving multiple classes of stock. So 358A1 will tell us what the aggregate basis of the stock is. And it's going to be the basis of the property contributed, which combines to 70, minus cash received plus gain recognized equals 65. So we've got 65 of basis. It's got to go sum to the common and sum to the preferred. And we saw in class under the 358 regs that when you have an aggregate basis on the 358A1, you got to split it among multiple classes of stock. You do it in proportion to their respective fair market values. So the common is worth 25, and the preferred is worth 20. So the common's fair market value is 25 out of 45, and the preferred is 20 out of 45. So we multiply that times 65, and that gives us 36K and change basis for the common, and 29K of basis for the preferred. Okay, so that's our 358A1 basis and the property permitted to receive without the recognition of gain. And again, we only have to worry about that if we have more than one class of stock received. Questions on that for B? Okay, what about the corporation's basis in the properties? Well, under 362A, the general rule would be they take the basis of the equipment equal to the B's basis in the equipment. And so we would take a basis of, go back to the fact pattern. It would be tract 1, not the equipment. Tract 1 gets a basis of 30, and tract 2 gets a basis of 40. So that's the starting point. But 362E2 comes into play here. 362E2 says when we have the aggregate basis exceeds the aggregate fair market value, that's 70 aggregate basis over 50 fair market value, we reduce these bases by that excess. So we reduce it by 20. And now we have to allocate the basis reduction among the two properties. Which basis do we reduce? How do we do it? 362E2 Cap B. Cap A says reduce by 20. Cap B says you reduce it in proportion to their share of the built-in losses. And this is pretty easy here. Number 1 has a built-in loss of 5. Number 2 has a built-in loss of 15. It would be more interesting if we had another piece of property that had a built-in gain, but now since we do that, 5/20ths of the reduction of 20 goes to number 1, and 15/20ths of the reduction goes to number 2. And so we're going to reduce number 1's basis by 5. Reduce numbers 2 basis by 15. So we reduced them to their fair market values. So the corporation takes a basis of 25 in each. Okay? And then C, C is contributing property with a fair market value of 100 and a basis of 20 and getting back 40 of stock common, 10 of cash, and 50 of debt assumption. So we can go back here and we can say, starting from the top, we could have C's amount realized is 100. So 50 of assumed debt plus 40 of stock plus 10 of cash. 20 is his basis. So he's 80 of gain realized. We have boot here. Recognize the gain realized equal to the lesser of the gain realized of the boot received. So we have 10 of gain recognized. This is not bad debt assumption either. We should mention that. This debt assumption, this is old and cold debt that was incurred to acquire the property. So it's not abusive type situation. And we'll compare a situation where 357B would come into play in a second, but here it's your classic non-357B debt. So we have 10 of gain recognized under 351B. We also, under 357C, we have 50 of debt assumed and only 20 of basis. So this is a situation where liability is assumed in excess of basis. So 50 minus 20, we have another 30 of gain recognized under 357C. So you have a total of 40. So the answer is C has 40 of gain recognized. Any questions on that? Again, whenever you have debt assumption, you got to worry about debt in excess of basis. Now, again, if you neglected to do this, you'd figure it out if you did everything else right. Because now in the 358, you'll say, okay, what's C's basis in the stock? Well, I'll go 358A1. Basis of the property contributed minus boot received. And for that purpose, debt assumption equals boot received. So it would be minus 60 plus gain recognized. Well, if you only had 10 of gain recognized, you'd still be a negative basis. And so you know you did something wrong. So but we have 40 of gain recognized. And so it's 0. And that's whenever you do a 357C apply and result in gain, by definition, your stock basis is going to be 0. Because the whole purpose of 357C is to avoid negative basis. So C has 40 of gain recognized, a 0 basis in the stock going forward. What is the corporation's basis in the property and the machinery contributed? 362A says it's the carryover basis plus any gain recognized. 60. So the corporation has a basis of 60 in the machinery. Okay? So that's A, B, and C. So B had multiple classes of stock. B had a built-in loss. 362E2 triggered. C had boot and a 357C issue.
Professor Polsky?
Yep, Max.
I have one question. I was thinking when I was doing this problem, with respect to A contributes, or A only gets cash. He doesn't get any stock
Right.
in 351. So do we just look on the whole group, what they get? Because if we just look at A, you don't have any stock there. Is
Well,
that an issue? Or
A
not?
is contributing. Well, so A is getting back stock. I mean, A really, yeah. I mean,
But
351
just for cash.
doesn't help A, but it's the same result under 351 as it would be under the general tax rules. A has no gain or loss, and A takes a $50,000 basis in the stock. And so you don't need 351 to get there. So 351 doesn't help A or hurt A. A is sort of indifferent. But cash is still property for 351 purposes. So A is still a property transferor, and that matters for B and C's purposes.
I have a question.
Yeah.
What kind of analysis are you looking for on like the fact that this transaction takes place over 11 days? Does that, it doesn't really look like an issue, but we might want to flag it anyway.
I should have mentioned that. There's a regulation. We saw the reg on the 351 that says, even though the statute says immediately after, that 351 regs say you consider sort of the transaction. I forget what the language used. If the parties' rights are defined in an agreement and it proceeds with expeditiously or whatever. So because this is all part of the agreement and the fact that it takes a few days to get it done, shouldn't be a problem. That's in 1.351-1A1.
Professor Polsky.
Yes.
Quick question I meant to ask you under Part B for 362 E2B. How would you do that if you had one property? I know you hinted at it.
If you have one property, if you only have one built-in lot,
if you had a built-in gain, is what I was going to say. Like if you had two with built.
Oh, okay. So you had two properties with the built-in loss and one.
Yeah, and one with built-in gain. Yeah. How would you affect the net total then?
Well, we did a problem, I think, just like that. But basically, let me see if I can give an example real quick. So let's say you have number one that has a fair market value of 10 and a basis of 20. So you've got number two that has a fair market value of 20 and a basis of 40. And then let's say you got property number three that has a fair market value of 50 and a basis of 40. Okay, so we got, so 362E2 applies because we have 80 of fair market value and we have 100 of basis. So we got to cram down by 20. And so here, 20, and the reduction is going to be 20 times 10 of built-in loss for number one over 30 of total built-in loss. One and two. So the reduction there would be 6.7. And here the reduction for this one would be 20 times 20 of built-in loss for number two over 30. It would be 13.3. So number one's basis would go down to 13.3 and number two's basis would go down to 26.7. So, and this is just the formula that's in 362 E2 Cap B. We're reducing the basis out. We're allocating the basis reduction among the properties so transferred in proportion to their respective built-in losses. That's what we did. Okay, any other questions thus far? All right, we got.
Yeah. I'm sorry, Professor.
Sure.
This may just be me not remembering Fed tax super well, but the fact that C had claimed the depreciation deduction. I know we had talked about a depreciation recapture issue, right. But
I mean, I didn't go. I mean, the income that C realizes, because all of the built-in gain is attributable to prior depreciation, that C's 40 of gain would be ordinary income under Section 1245. I wouldn't probably hold it against you if you didn't, mention that, because we're not really talking about that. But for your own purposes, yeah, you're right that C would have ordinary income. But that's far less important for this class than what I covered. And there's also holding period issues, but again, we didn't really deal with that so much. And so I'm not as concerned about holding period stuff. All right, any other questions? All right, let's go on to the next part of the problem. So now B is now elderly, going to hold onto the shares until he dies, which means he's going to get a stepped up basis, which means that his basis in the stock, remember his basis in the stock was a total basis of 65. Is there a way to improve? And so this is, I thought, pretty clearly getting at the election under 362 E2 cap C, where the corporation and C can agree that instead of reducing the basis of the land, remember we crammed down the basis of the land, that we can do it by reducing the basis of stock, the C's stock. And if so, we would reduce C's basis in the stock from 65 down to 45. 25 in the common and 20 in the preferred. So another way to say this, instead of reducing the basis in the land down to fair market value, we're going to reduce C's stock basis down to fair market value. And the reason why this would be attractive is if in fact B does hold the stock until he dies, then his basis in the stock is irrelevant, at least under current law. And this is Biden, right? Wants to get rid of the stepped up, stepped down basis, so. But if he's going to hold it to death, the basis in the stock becomes irrelevant. And so giving up some of his basis and giving it to the corporation is a win-win. So that's what they should do. The risks that B would have would be, well, if he doesn't end up holding the stock until he dies, now he's given up basis in the stock. Lose basis in your stock, it means you have more gain or less loss when you sell the stock. So it would be kind of like, are you sure? If you're sure you're going to hold it till you die, then there's no cost to doing this. But if there's a 1% chance you're going to sell before you die, then you got to weigh that against the benefit you're giving NewCo. NewCo's benefit is to give NewCo more basis in the land. And it's, and land is not depreciable, so it's not as attractive than if this was like equipment or machinery. You're giving NewCo more basis in depreciable property. You get to use that basis. So it's not a great result, but it's better because again, if B's basis is going to be lost anyway, then why not? Okay. And then finally, on 3, yeah, go ahead.
A question just about the 362 E2C election. Something that I kind of got confused about when I was working through this and reading some of the materials about that election was the order of operations kind of in determining basis. So, under the, do you, like, the interaction between the E2C election and the operations under Section 358 to adjust basis.
Right. I mean, so so what you would do is under 362 E2 cap C. Remember, 362A would give the corporation a carryover basis in the land. 362 E2 cap A then comes in and says, nope, we're going to reduce that basis in the land by 20. Right, aggregate basis by 20. 362 E2 cap C says, well, if you don't want to reduce the basis in the land by 20, then you can reduce the basis in the stock by 20. And that basis in the stock would be the basis that you would reduce would be the basis you get under 358. So you sort of start with your 358A basis in the stock, you start with your 362A basis in the property the corporation receives, and then without any election, you reduce the corporation's basis in the property. With an election, you reduce the shareholder's basis in the stock. Any other questions on this? Okay, and then 3, so this is teeing up the sort of the bad purpose debt assumption. So your classic, you know, oh, C will borrow against the property being contributed on the eve of the contribution, go use the cash for personal purposes. And so 357B says when you have this bad purpose borrowing or assumption, then you treat all your debt assumed as cash. So, and 357B takes precedence over 357C. So now we're just dealing with 357B, and so now we have a situation where, get back to C, C's amount realized, again, is 100. C's basis in the property contributed is 20. C has 80 of gain realized. But now the boot received is the 10 of actual cash plus the 50 of debt. So now it's 60 the boot received. So now the lesser of is 60, so 60 gain recognized. So that's an extra 20 of gain recognized, because before we had 40. And then that's going to ripple through, and that'll mean what is A's basis, C's basis in the stock is the carryover basis minus the boot received plus the gain recognized, so 20. So instead of 40 of gain recognized or 60 of gain recognized, instead of 0 basis in stock, there's 20 of basis in stock. That'll make sense. And the corporation's basis in the property is going to be under 362A. It's going to be 20 plus 60 equals 80. And that's all 357B doing all that work. Well, doing the work, doing a lot of work here. That's the big change. The big change ultimately in this problem is that we go from having a debt that's not a 357B situation under the basic facts, and now we change it to being that 357B type debt. And it's going to have effects on C and also on the corporation, but no effects on A or B. Okay, any questions on that? Okay, that's problem one. That's a pretty straightforward. Yeah, go ahead.
Just one question about the improper purpose analysis.
Right.
Is, you know, I remember you know, when we talked about it, but I don't recall like really spending a lot of time or looking at a lot of examples of what an improper, you know, kind of what makes it an improper purpose. I think, you know, here, kind of what I would have said is, you know, he's just trying to offload a personal debt onto the corporation and avoid assumption of or cancellation of debt income, something like that.
Oh, he's trying to cash out,
Yeah,
without receiving cash, you know, 351, right? That's the whole idea.
okay.
Yeah, I think we talked about, I mean, basically what you're looking at is, and again, I think these are pretty far extremes. You know, so in the original facts, you had sort of old and cold debt used to buy the machinery itself. So if, you know, if it's old and cold and it was incurred before anyone even thought about doing a 351, that should be fine, regardless of what the debt is used for. Likewise, if you use the debt and you reinvest the proceeds or use it to buy the property or use it to improve the property or use it to use the proceeds to, if you're incorporating a business, to plow it back into the business to pay things like wages and the like, that should be fine as well. And so you're left with really sort of like loans that were incurred in anticipation of dropping the property down, where you're using the proceeds not to buy, improve the property, or otherwise relate to the property that's being contributed. So cashing out to use for personal purposes. So these are kind of like the two extremes, but I don't think, yeah, you can imagine maybe situations that are a little bit blurry. We didn't cover them and they're quite rare. And basically you don't do what C did because it won't work, right? I mean, so, but anyway, I think what we know, what we covered, I think is good. All right, any other questions on 1? All right, 2 is a problem. It's a little bit annoying because there's sort of a lot of numbers going on, and so you got to keep things straight. It's maybe a challenge. This is why maybe having extra time is nice. It's not you can see that my style is not to write long fact patterns. I don't give you really much. I don't give you any information that's not other than what's necessary. But we have distributions made during the year, and we've got redemptions down here. And then we've got E&P, and we're going to see there's just insufficient E&P to cover all the distributions. The first thing we really need to do is to figure out whether these redemptions at the end of the year are going to qualify as sales or exchanges, or instead be treated as redemptions. Right? Because if they're treated as distributions, then we'll deal with them in the context of distributions. And so when Paul sells 15 and Rachel sells 20, are those going to be sales or exchanges, or recharacterized as distributions? So let's start with Paul first. And this requires us to understand what Paul owns before and after. So Paul before. Paul owns 20 directly. Paul owns 25 through Rachel, his spouse. He owns 15 through Nick, his father. And NPR itself, so NPR owns 30 shares. Paul owns 1/3. Rachel owns 1/3. And Nick owns 1/3. So Paul is deemed to own all of NPR because his spouse and his father owns the rest of the shares. So he owns 100% NPR. And if you own at least 50% of a corporation, you're deemed to own a proportional amount of the shares owned by the corporation. So it's going to be 30 through NPR. So that adds up to 90 out of 100. So Paul owns 90 out of 100 before. The only shares that he doesn't own, deemed not to own, is going to be the shares owned by his grandparent. Okay, so that's what Paul owns before. And then after, well, he's getting 15 are being redeemed by him. 20 are being redeemed from Rachel. Nick still has 15. NPR still has 30. And that goes to 55 out of 65 after. Because the 15 here and the 20 there come out of the numerator and the denominator. And that goes from 90% down to 84.6%. So that's not substantially disproportionate because we have to get below 50% as a threshold matter. We don't. It's not a complete termination, obviously, because Rachel still owns, I'm sorry, Paul still owns shares. So we're left with meaningful reduction. It's going to be impossible, I think, unless there's really weird facts, for this to be a meaningful reduction. Because again, Paul, after attribution, dominates this company's voting power. So the bottom line here is that this will be the $450,000 of redemption proceeds that Paul receives will be recharacterized as a distribution. Okay, so Paul's redemption is now a distribution. Any questions on Paul? All right, we go to Rachel. So Rachel before owns 20 through Paul. $25 directly. Nothing through her father-in-law. And Rachel will be deemed to own Paul's shares up here. So Rachel owns 2/3 of NPR, but not this third. So Rachel's deemed to own, since she owns more than 1/2 of NPR, she owns proportionally NPR shares. So she's going to own 20 through NPR. 2/3 of 30 is 20. So that's 65 out of 100. And then after, she owns Paul's 5, she owns her own 5, and she still owns 20. So she owns 30 over 65. So that's 65% down to 46%. And this qualifies as substantially disproportionate. She gets below 50%. Keep in mind, there's only one class of common here. If we had multiple classes of common, non-voting and voting, we'd have a little bit more complicated situation, but here it's easy. We have one class of common. So she goes down to 46%, that's below 50%, and it's also below 80% of 65%. So this is substantially disproportionate. So Rachel's redemption is treated as a sale or exchange. Okay, so Paul's redemption is treated as distribution. Rachel's redemption is treated as sale or exchange. Once we do all that, then we can say, okay, how much distributions do we have? Well, we have 200,000 of, we can call them ordinary distributions. That's just the cash distributions during the year. And then we have 450,000 of redemption distributions. Paul. So that gives us 650,000 of distributions. We have 520,000 of current E&P. And we know the rule is when you have current E&P is insufficient to cover all the distributions, you prorate. And so you put it over the total, that gives you 80%. So 80% of the distributions are going to be covered by current E&P. So we can start to go through this. And we can say, okay, for Mary, she owns 10 shares. She's receiving 20 of distributions. And of that, 80% is covered by current E&P. So 16K is covered by current. And then we have to deal with accumulated. But let's just start there. So Mary has 10 shares. Nick has 15 shares. Distribution of 30,000. 80% is current. So 24. Paul, 20 shares. 40,000 distribution. 32,000 current. Okay, does everybody see what we did there? And then with accumulated, we drop that on a first in time basis. And that's totaling 20. And because these distributions on July 1 occur simultaneously, we're going to prorate this 20,000 among these amounts. And so 10% is going to go to M, 15% to N, 20% to P, 25% to R, and 30% to NPR. And in terms of the dividend, for each person, it's the sum of these. So there's your dividend amount for each one, 18 for M and so on and so forth. I'll just mention one other thing that you should know. We didn't talk very much because NPR is a corporation. NPR will also receive a dividends received deduction. So that's 54,000 of dividends, but then a dividends received deduction under these facts equal to 65% of 54,000 because NPR owns more than 20% of the issuing company. But again, we didn't really talk much about dividends received deduction. I just mentioned it to close the loop. The next layer, we got to do reduction of basis. So we've got 2,000 of distribution to M we didn't cover yet. So we reduce basis by the remaining 2 for M. We've got 30 of distribution, 27. We got 3 left for N. We've got 4 left for P, 5 left for R, and 6 left for NPR. And so we can put our ending basis here. Is our original basis, which is 1,000 per share. So 10,000 minus 2 is going to be 8. 15,000 minus 3 is 12. 20,000 minus 4 is 16. 25,000 minus 5 is 20. And 30,000 minus 6 is 24,000. So ultimately, these are your dividends. and this is the basis of the stock thus far. Okay, and again, this is the challenge here, besides the law, which I don't think is that complicated, is just like keeping track of all this. Again, maybe this problem, I've learned, I've gotten older, I've gotten more mature. I probably wouldn't give as many shareholders here. I'd probably make it a little simpler. I don't like having all these numbers flying around, but yeah, it's not that unmanageable. Okay, so that's that. Any questions on that? That's July 1. We still have to do the redemptions. So the redemptions, let's do Rachel first. Rachel's redemption will be respected. So Rachel is selling 20 shares. Her amount realized is 600. Her basis in all of her shares is now 20, but she's only selling 80% of her shares, right? She has 25 shares, she's selling 20. So we'll take that 20,000 basis and give 80% to the sold shares. So that's 16,000. So she'll have 584,000 of gain. Assuming she held the shares for more than a year, there'd be a long-term capital gain. And then her remaining basis is 4. In the 5 shares left. Okay, so that's Rachel. So to sum up for Rachel, she's going to have 45 of dividend income, 584 of long-term capital gain, and 5,000 of basis, 4,000 of basis in her shares left. For Paul, Paul's receiving a $450,000 distribution. %, is a dividend out of current E&P. The remaining 90 is going to reduce his basis. So 16 will be tax-free reduction of basis. The excess will be gain. So he'll also have 74,000 of long-term capital gain. And he's got 0 basis in his shares left. So summing up for Paul, Paul has 36,000 of dividend income here, 360,000 dividend income there. So that's 396,000 of dividend income, 74,000 of long-term capital gain, and 0 basis going forward. And then in terms of M, N, and NPR, they are unaffected by these later transactions. And of course, there's no accumulated E&P going forward. We've drained it all. So that's that. So this problem just combined really 2 things. It was a 302 redemption analysis for Paul and Rachel, and then it was, a distribution of cash involving current and accumulated E&P, which we did them both. I don't think we combined them in a problem so much, but here we did. Again, I think this is a fine problem. I'd probably reduce the number of shareholders at least by 1. Going, in terms of just making that problem a little more manageable from a numbers perspective, but it also makes it more interesting from an attribution perspective. But I probably could have done the same with 4 shareholders instead of 5. Okay. Any questions on this? Okay, the last problem is much more straightforward, at least in terms of the fact pattern. We did something pretty similar to this in class. And it's just this divorce situation involving redemption. So H and W each own 50%. They have pretty low basis in their stock, 100 each. they're going to divorce, and the husband is going to be obligated to purchase wife's shares for 10 million bucks. And instead, the corporation buys wife's shares for $10 million. And in the year of the purported redemption, we have 8 million of accumulated earnings and profits up to the end of the prior year, and then we have $1 million deficit the current year. And the purported redemption occurs on October 1, which is 3/4 of the way through the year. So the beginning of quarter 4 is when this happens. So we start out, what are the consequences? This is that law that says that you look to, if there's a redemption, but a shareholder had a primary unconditional obligation to buy the shares, and instead the corporation redeems those shares, that's recharacterized as a distribution. So this is going to be recharacterized as a distribution of $10 million to husband, because he has a primary unconditional obligation to buy the shares. So we have a $10 million distribution. So the recast is going to look like this. It's going to be the corp distributing 10 million bucks to H, and then H is then going to buy the shares of W. So this $10 million distribution is a 301 distribution. So we have to say, well, what's the earnings and profits? And we had 8 million of accumulated and negative 1 million, 8 million accumulated, negative 1 million of current. And remember, when we have this situation of negative current and positive accumulated, what you do is, if you can't trace it to any particular quarter or any particular timing, you just prorate the loss, and you'll treat the loss as being occurred 250 in quarter 1, 250 in quarter 2, 250 in quarter 3, and 250 in quarter 4. And the distribution's occurring right there. So our accumulated E&P at the time of the distribution is 7.25 million. So husband is going to have 7.25 dividend income. The next 100,000 is going to be tax-free recovery of basis. That leaves, we're now at 7.35 million, so that leaves 2.65 million of long-term capital gain. And then wife, and then H is going to then take $100,000 basis in the stock. We talked about this. Because it's tax-free, husband transferring to wife property, that there's no gain or loss recognized. That's section 1041 of the code. And so it takes a carryover basis, and W has no gain or loss. And then corp's accumulated E&P would be negative 250, because We got that last year. We didn't go over this that much in class. When I tested this, I think we probably spent more time on this particular type of a problem. So if you think this is a little bit beyond the pale of where we went, it probably is for this class, although again, it's a good review of some of this stuff. But the bottom line is, let's keep track of this, that if we do it here, we've got 7.25 million of dividend income and 2.65 million of gain for husband. So husband doesn't like this at all, but wife's pretty happy because she's got $10 million tax-free. Okay, any questions on that? That's just if the transaction goes forward as is. Well, then we talked about that you can, there's some private ordering you can do here. That under the regs that deal with this in the divorce context, that the parties can jointly agree that they're going to treat this as a redemption, respect as a redemption. So what if it's respect as a redemption? What consequences then? Well, now it's just a redemption of W. So now W is getting redeemed. When W gets redeemed, that's going to be a sale or exchange because W is completely terminated. There's no longer any attribution from H. They're no longer spouses. So that's going to be respected as a redemption. And so W's amount realized is going to be 10 million. W's basis in the stock, her basis was 0.1. So she's going to have 9.9 million of long-term capital gain. 1041 doesn't apply. It's no longer a transfer between spouses. So W has 9.9 million of gain. I should put up here that the corp was going to have 250 of E&P deficit. Just to close the loop. So here with the, so this is with a, with no election. Here is with the election. W is going to have 9.9 million of long-term capital gain. The accumulated E&P at the time of the redemption was the accumulated E&P at the end of the year, remember, it was 8 million positive accumulated minus 1 current. So there's going to be 7 million accumulated at the end of the year. We did talk very briefly about the rule that says when you have a redemption treated as a sale or exchange, that the proportional amount of accumulated E&P goes away with it. So here, since half the shares are going away, half the accumulated E&P goes away. So the corp will have 3.5 million of accumulated E&P going forward. We didn't really talk that much about it. It's not really all that important, but that's basically the gist of it. And you can see that, leaving aside some of the character differences, it's pretty similar. It's basically who gets popped. And without the election, H gets popped. With the election, W gets popped. If everyone's thinking appropriately, then they should take that into account in settling the deal and settling the marital estate. Somebody's got to get it, so you just account for it and say, we'll split the effective cost by adjusting the amount of the settlement. But if one party is thinking about taxes and the other party isn't, then it's pretty easy to pull one over on the other party. So it depends like how dumb you think the other side is. The last question here is, well, the second one. And I guess, well, let's go back. If both parties are thinking well, then you'd want to put it on, you want to decide which reduces the tax liability from a joint perspective. Again, because then you'd split the marital estate after taxes. And so you would then want to think about things like who's got capital losses that can be used. If there's a bunch of capital losses can be used against the capital gains, but not against the dividend income. So you can imagine if both parties have lots of capital losses, then this looks better because W can then use some of her capital losses against that capital gain. But if you represented W, you would say, no way we're doing this election, or we're not going to do the election unless we change the deal significantly, because it's effectively shifting a bunch of taxable income from H to W. So you would say, no, don't make that election. And then finally, this is a more technical point, back to 1 where it's treated as a distribution to H. What if we can establish that the entire deficit was incurred during the first half of the year, and that in 1 month, and then in the rest of the months they broke even? So just back to, this is a distribution. So we have a distribution to H, $10 million distribution. And what that means is that, again, we take the year, when we go to October 1, before October 1, we lost $1 million. And then after October 1, we broke even. So that would mean the accumulated E&P would be now 7 million instead of 7.25 million. And so that would mean 7 million would be a dividend. Another, again, 0.1 million recovery of basis, and 2.9 million of long-term capital gain, compared to before we had 7.25 million, 0.1 million, and this was 2.65 million. So by doing that, establishing that the $1 million loss occurred all before, what we did is we converted $250,000 of dividend income into $250,000 of long-term capital gain, which again may not matter because the maximum rate's the same, but it would matter if, for example, husband had capital losses. But the answer to that last part is this would be the consequence, rather than this. So again, I think this problem, again, I wouldn't give you this cold because we didn't spend enough time on this particular sort of set of facts. But that being said, the corporate tax elements of this, you should be comfortable with. The 1041 stuff, again, is a little afield. And then this problem too, I think is, at least as a matter of what it covers, is just fine. A little messy with the numbers. And then problem 1, you should be able to do 351 stuff pretty easily by the time you take the exam. And again, notice like pretty short fact patterns, right? 1 page each. Make sure you answer the questions that are asked. Don't answer questions that aren't asked. I try to break things up into subparts. That helps me grade, and so try to follow the way I do it, looking for these answers here. And that's about it. Any questions about problem 3? Any questions about any other problems?
Yeah, quick question on problem 3.
Yeah.
I don't have my codes pulled up in front of me, but with the redemption of the wife shares, if they make the election, if it's a complete redemption, does that turn off family attribution? I couldn't remember about that.
So, well, in this case, there is no attribution because they're divorced. In, what do they say? I think it's the divorce happens. They're divorced on December 31, year 1, and they make the redemption would be deemed to happen on October 1 of year 2. So they're no longer related. They're no longer spouses. So wives, you wouldn't need to do any of the paperwork for a complete termination because you don't need to waive family attribution because there is no family attribution. You're no longer family. Any other questions, Max?
Yeah, Professor, I have one last question. In the instructions, it said that a complete answer would include citations to authority where appropriate.
Yeah.
So shall we cite the relevant rules and cases if necessary? I mean, cases.
Yeah,
where
I mean,
not
so you don't need to cite chapter and verse. What I need you to do, and I think this is sort of an older exam, so again, things have made things better, but you need to explain how you arrived at your answer. And so you don't need to cite code sections or regs or cases. You can, and oftentimes students do, but it's not necessary to get all the points. You just need to show me what you did. And so whether you refer to 368C for control, or whether you say, it satisfies the control requirement or it doesn't. I mean, again, I'm not a stickler for style. There are lots of ways you can get all the points. And I ask you to tell me how you arrived at the answer for 2 reasons. One is to make sure you did your own work. And number 2, more importantly, because I trust you all to do your own work, more importantly, that if you do make a wrong turn or make a math error, I can then reconstruct what you did and give you, generous partial credit as deserved. And so I wouldn't worry about stylistic questions. Just you want to explain what you did, like if you were, teaching someone, explaining, how you got your answer. Again, I'm looking for you all to get full credit, and so I'm not looking for ways to screw you out of points. So don't worry about that. Again, there are different styles for conveying that information, and I'm fine with each. And so I've given complete credit to answers that are really detailed citation every sentence, to other explanations that have no citations but explain very well what they're doing. Other questions?
Yeah, just a question about the instructions. It says that while the answer should be typed, we can turn in handwritten tables, or I guess other things where we were doing our math.
Right. So
just logistically, how would that work?
Yeah, so you'll have the ability on Twen to upload, so you'll have to have a typewritten answer with explanation at a minimum. And some students, you can do all that in there, right? And if you want to have tables and you can do it on Word, you can do it like that. Some students will also, you'll have the ability to upload like a PDF, and it could be handwritten if you want. Again, make it sure it's legible and understandable, and that will be more of like the table stuff that we went over, that we just did. And so you can, I'll look at both. And oftentimes when students do that, they'll refer from one and they'll say, see, see tables, see table number 1 or table number 2 or page number 1. And so that works out pretty well. And so you can, depending on how you feel, you can take advantage of that. So you'll have the ability to upload more than one document. I'll also include my assistant's email address so that if you think you're having any issues on Twen with uploading, you can also email her and she'll get it to me scrubbed of any personal identifying information, so that you'll have that backup if necessary. And like I said, you'll get the instructions before the exam period begins. So take a look at those. They may look pretty similar to this, but and if there are any ambiguities or questions, let me know. Okay, any other questions or comments, concerns? All right, so I will be around, so feel free to reach out, and good luck on the exam. Good luck on all your exams, and have a good summer. And like I said, don't hesitate to reach out. Okay, bye-bye.